This video is for educational purposes only and should not be considered financial advice. What is the level 2 of the ICT market maker model? Outline: the market maker model, higher highs and lower lows. The levels as ranges. Examples. Recap. The market maker model. The market maker model by ICT shows how price action moves from one level to another, and it usually moves in 3 levels. Level 2 is usually the setup for a big move to level 3. And this is most likely because all of the opposing price action to the left of the chart has been mitigated or cleaned up, as they say. And it is usually a clear shot to the intended price level of the market maker's level 3. Higher highs and lower lows. Typically, in my explanation of level 2, I am counting higher highs or lower lows that have closed beyond level 1. Level 1 is a higher high or a lower low that closed beyond the previous high or the previous low. When using the higher high or the lower low method, sometimes level 2 can also encompass level 3, because it is key to think about the market maker model as an area of price action. The best way to measure this area is to use the level 1 range and extrapolate that to get the level 2 range. If the higher high or the lower low, level 3 is still inside of the level 2 range, then it is still considered part of level 2. But what we are looking for is a move outside of the level 2 range to create the real level 3. What usually causes the move to level 3 is liquidity being taken inside of the level 2 range, and then price moves quickly away from the level 2 range. This dovetails into our previous video on extended candles. You can look for price to take the liquidity of the level 2 range and then tap into the extended candle inside of that level 1 range. By popular request, I've launched a Patreon where I share my weekly trades and show exactly how I apply my strategy in real time. Plus, I've set up a Discord channel so you can ask questions and learn with others. I'll be checking in each week to answer questions and offer insight. If you've been wanting to dig deeper and grow as a trader, this is a great way to start. Check the links in the description and I'll see you inside. Examples. Let's take a look at some examples. This is an example of the level 2 discussion. And if we look at this level 1 that's created here inside of this larger consolidation, we have the range that is measured out from the top of the candles, not the wicks, but the candles and the bottom of the candles. And then we copy that range and then stack it on top of the level 1 range, and that's where you'll get your level 2 range. Level 3 can be a lot farther away, but this time it's right next to level 2. And sometimes level 2 can be farther away as well. But when you see consolidation, that's what you're looking for, is the same range as level 1. And so after we come out of level 1 and then go back into it, you're looking for a reaction from an extended candle inside of level 1. So we see an extended candle here, and we see extended candle here, and you're actually getting a smaller market maker model inside of level 1. And then when price reacts from that, that's when you're looking to take your entry. Now, there's multiple entry models you can use. You can wait for the swing level to be created. So this is the swing low. And once this candle is broken, that's your entry right there. You can take that model. Or you want to look on a smaller time frames. This is a 1-hour chart for your entry model. But this is again to see level 1 and using the level 1 range, level 2, and then level 3. Like I was talking about earlier with counting these swing highs, if we counted the swing highs, we would get level 1 inside of here and then level 2. And All of that happens inside of a level one move from a larger concept. And then you have level three that creates that top of the range of level two. And then we have again a level one created inside of this level two range, and level two in terms of counting higher highs completes at this level three. So there is a difference between counting higher highs and higher lows than versus counting the ranges of the market maker model. Let's look at a bearish example. If we measure out our level one, which will be from the top of the candle to the bottom of the candles, and then we stack it on top to the bottom of this candle, here we see our level one, our level two. Level two reaches into an extended candle on level one, and then takes a move to the downside to create that level three. And let's see if the level three's range is exactly the same as the level one range. We look at the tops of the candles, the bottom of the candles, it's close to the same range. But like I said, level two is more closely aligned to the range of level one. Level three can be way far away, but usually the range is very similar to the level one range. Let's look at one more example. We get liquidity taken, then we see a level one. You extrapolate that and you get your level two created. And then once the level two range, completion of the level one range, it goes back into level one to tap into an extended candle, and then it moves to the downside. But this is your market maker model. Hopefully that was helpful to you. Recap. To recap, level two is mainly a concept more than the higher highs and lower lows. However, it helps immensely to use the level two counting of these higher highs and lower lows to count the market maker model. Just make sure in the back of your mind that you have the larger concept of the ranges of the market maker model. We hope this helps clarify the level two discussion, and let us know in the comments if you've had success using this method. Also, like and subscribe for more videos. Thank you for watching.